Hello, everyone. Welcome back to the channel. As always, please subscribe if you have not already. I am not a life insurance agent. I am not a financial advisor in any capacity. I'm just simply a guy that really likes personal finance and the infinite banking concept. Today, as I am enlarging on the screen, we are going to be talking about how I believe that infinite banking policy should only be used for investment purposes, ideally, in an ideal world. Of course, there isn't always going to be this truth, but it would be preferable. And I don't think anyone would disagree with that. I'm just going to talk about why. As always, let me know in the comments below what you think. Whether you agree or disagree, it's perfectly fine. I love having discussions, and I love having, I guess, critical discussions in the sense it's okay if you call me out. I will respond, however, and I will admit if I am wrong, at least if I believe I'm wrong. The reason why infinite banking policy should only be used for investment purposes is because how they actually work. And so, first of all, let's cover infinite banking, how it typically works. So the idea is that you earn money, and the idea is you are going to deposit that in an IBC vehicle, which is typically a whole life insurance policy. And this policy will typically compound at, give or take 3 to 4.5%. It really depends in today's environments. And the idea is that you are going to borrow this money in the form of a loan, whether from the insurance company or from a third party, and you're going to use this for investment or spending purposes. And the idea is that the money that you earn from this investment or the money you would have otherwise spent on this spending is going to go back to pay the loan, and then you're going to rinse and repeat this. So the idea is, on the loan side, you are going to have simple interest, and on the infinite banking side, or at least the whole life side, you're going to have continually compounding uh, growth. Okay, so that's the idea there, and how this ends up working. The challenge with this is, and when you start doing the math, because you go, okay, I'm currently saving on a yearly basis, $10,000, let's say. Okay, perfect. So what I'm going to go do is I'm going to take a $10,000 policy, and I'm saving this up for a car. And let's say, I'm saving, I don't know, mm, whatever it ends up being. It doesn't really matter, but my premium's going to be $10,000 per year. And then you just go, okay, I'm going to borrow this money. And then you start to realize, okay, if I borrow $10,000 and I'm paying $10,000, how am I supposed to pay this loan back if this is all I was saving? So this is and I have another video on this, and I'll link it in the description below. But if you are saving all of the money that you are going to be spending, then there is not going to be any method to repay this back, especially if what you're saving for is not for investment purposes. This really only applies in the event that I can't move my screen for whatever reason. Okay, there we go. This really only applies when you're talking about the spending. So the idea would be that you go and borrow money, and you can typically borrow money in uh, either from the insurance company or a third party lender, typically for like 3.5 to say 6.5% interest. Of course, this isn't today's interest rates. Things may change if you're watching this at a later date. But the idea is, for example, if you can go buy a piece of real estate that is getting a 20% annual return, including principal repayment and you name it, okay? Well, the idea is that you are now making the difference between these two, and you would use the difference to then funnel it back and pay back the loan. And then you're creating this self-fulfilling cycle where eventually your investments, whatever those may be, are fully covering the cost of the actual policy premiums themselves. If you get to a point where you have borrowed more than you can pay back, this can become troublesome. It's not the end of the world. Uh, there have been videos done by some American infinite banking practitioners, I guess teachers, that say that it's better to pay back a loan than it is to fund the policy, because the policy will typically borrow from itself to fund the premium. However, if we can avoid that, of course, we want to, right? And so this is really the true power of um, infinite banking, infinite is used in many different ways because there's many different possibilities. Some talk about it being an infinite return, but, let's say, for example, if you invest $10,000 and you're making $1,000 per year, your cash on cash return would be 10%, which is great. Okay. However, now if you're talking about leverage and you're not actually taking $10,000 of your own money, but instead you're borrowing it from the insurance company, and on $10,000, your actual cost is, let's say on the low end, $350, but you're now making the same $1,000. Well, of course, your return is several 100%, right? Because you're making way more than it's actually costing you to service this. And in this example, what you would do is you would take the difference of 650 bucks, and you then would go and apply it towards the loan to pay it back. And because your costs are 350 and you're paying back 650 over time, this loan will get paid back, and in theory it didn't cost you a penny. And when the loan is paid off, you're now making a full $1,000 a month. So I hope that makes sense as to why I believe that you should only use your policy for investment purposes in an ideal world. Let me know what you think below. Cheers. Bye.